Hello, welcome to Accounting 2010 Chapter 11 videos. In Chapter 11 we are going to be discussing current liabilities. So what are current liabilities? Well, current liabilities could be defined as debts, duties, or responsibilities owed to others. They also can be defined as obligations owed to others. Sometimes liabilities occur when we were paid money for future work. Remember, that was called unearned revenue. Sometimes we use products or services from others and we got to use them without paying, and now we must pay in the near future. It means we have a legal responsibility to pay others, and if we did not, we could be turned in for debt collection, or lawsuits or other means of collection could be filed against us. So current liabilities are debts, duties, responsibilities, or obligations that we owe to others. So how do we define the word current? Because we're going to be looking at non-current or long-term liabilities in the next chapter. Well, current are those liabilities, those debts, which must be paid within 1 year or in an operating cycle, whichever is longer. So sometimes we have operating cycles which are longer than 1 year. A couple that come to mind are vineyards or long-term contracts on building properties, things which can take more than a year to complete. Typically, when we're talking about current, we're talking about 30 days, 60 days, or 90 days, but it could be up to a year. What are some examples of current liabilities? Well, a big one and a major one is payroll. Payroll can be a very significant current liability. If we have a current portion of a note payable or a mortgage payable, that portion which is due within the year or certainly within the month, those are considered current portions of long-term liabilities. Our accounts payable are current, things like our power bill, our cable bill, any of those types of bills. Perhaps if we've purchased inventory on account, that could be considered an account payable. Warranty obligations are considered a liability. We call those contingent obligations. They're contingent on something happening, like products being returned to us. Sometimes gift cards, if we are a business that sells gift cards, we will have unearned revenue or unearned obligations that are associated with those gift cards. And of course, any taxes that we collect, sales taxes, or payroll taxes, those are considered current liabilities. So the first one we're going to talk about is the current obligation of payroll. And payroll is a major obligation for most businesses. Payroll is also a very interesting topic that benefits most of you in this course. So payroll has multiple components. It has the actual salaries that we pay to our employees. Out of those salaries, we collect on behalf of our employees the federal income taxes that they must pay with their earnings. We also, as employers, will collect any Social Security taxes or Medicare taxes that are associated with our employees' earnings. We will collect any benefits to pay things like health insurance or retirement plans. We might take those out of employees' checks. We must pay unemployment taxes on our employees, both state and federal unemployment taxes. If we collect any state income taxes, those are going to be liabilities. And then as employers, we also have matching taxes on some of the taxes that we take out of our employees' paychecks. So those are all types of payroll liabilities. So I made up this little illustration to show you the different sides of payroll obligations. So here are some of the tax types. We'll talk about them, and then who is actually the one who is paying the different types of payroll liabilities. So the first one we have are employees' paychecks. When we pay our employees a salary or a wage, a salary typically is something which is a set amount that we pay for a set amount of work, where wages are typically considered hourly. And the rate of the different taxes changes. So federal income tax, let's talk about that first. The federal income tax, which is withheld from our employees' paycheck is an amount that they declare to us based on a W-4 that they filled out. So let's look at a W-4. Perhaps all of you have filled this out at one time or another. When you begin work with an employer, or if a life circumstance changes, you are requested to fill out a W-4, an employee withholding allowance certificate. And it is on this declaration that you are requesting that the IRS, or excuse me, that your employer tax you at a rate that you will have a certain amount of money withheld based on your estimated tax circumstances. You will have lots of things to consider when you are declaring how much withholding you want. Do you have any dependents? Do you file married filing joint? Do you file single, head of household? Do you have any deductions? Are you an itemizer of deductions for a Schedule A? Do you file a standard tax return and a standard allowance? Those are all questions that you will be asked in this form when you declare how much federal taxes you want withheld from your paycheck. So this is a very important form that you fill out correctly, because if you have too little withheld from your paycheck, then you may owe the federal government, when you file your tax return, additional money. If you have too much withheld, you would be owed a refund. And I strongly suggest you try to get the amount withheld that very closely matches what you will owe in taxes, because you do not want to have, especially with identity theft, too much withheld from your paychecks. Because if you're waiting for a refund and somebody else files your taxes in front of you using your Social Security number, it is possible that they can be given your refund. And it can take months or even years to resolve this with the IRS and to get your refund. So when you are filling out this form, try to estimate how much you should have withheld very closely. So let's go back to this form. If you look, the employee has federal income taxes withheld from their paychecks. The employer does not pay any additional taxes. All the taxes are paid through the employee's paycheck. State income tax is exactly the same. This will be based on how many exemptions you claim, and it will also be based on individual state laws. When you're looking at relocating to a state, when you finish your college degree, you might want to take into consideration what are the state laws governing state income taxes. There are states which do not have any state income taxes. There are states which have no sales tax. There are states that have no property taxes. And there are states such as Colorado that have all of those taxes, but all based on a fairly low tax rates for all of them. So it will be something that you will want to consider when choosing where you want to live or retire. So once again, those taxes are taken out of the employee's paycheck. The employer does not have any additional taxes associated with the federal and state income taxes. The next step is called withholding is the FICA, OASDI, and that is the Old Age Survivor and Disability Insurance. OASDI is otherwise known to you as Social Security, and Social Security is withheld from your paycheck at a rate of 6.2%. Now, in your book, you're going to see a 4.2%. The book is now about 4 years old, and for a brief period of time after the recession in 2008, the federal government gave employees a tax holiday. They reduced the Social Security tax by 2% to put extra money into the employee's paycheck. That is no longer in effect, and 6.2% is being withheld from your paycheck. The employer is also required to match at 6.2% of your earnings of Social Security. Now, the Social Security we'll see in a bit does have some other limitations to it, but OASDI, Social Security, FICA OASDI, has a 6.2% for the employee and 6.2% matching for the employer. FICA Medicare, that is the Medicare portion of the Social Security taxes that you're aware of, is taxed at a 1.45% with no ceiling. And what do I mean by that? The Social Security actually has a ceiling attached to it where the earnings attached to it. FICA Medicare does not. The employer must also match that 1.45 with no ceiling of earnings. Then we have the federal unemployment tax and the state unemployment tax. And these are not taxes which are paid by the employee out of the employee's paycheck. Those are taxes which are imposed upon the employer. This is if an employer is laying off people. The unemployment insurance fund of the state is where the employee can file for unemployment. And for the federal, it's the 0.6% up to the first 7,000 of each employee's earnings, and 5.6% up to the first 7,000 on the state level. Now, when an employee files for unemployment, they've been laid off, they will file with the state. The state is the first level which is responsible for paying unemployment. If the states run out of money for their unemployment insurance, which they did after the recession in 2008, the federal government will start to give the states money to cover the unemployment. What happened after 2008 is that not only did many states run out of unemployment insurance, but the federal government started having a lot of problems with wanting to pay this additional unemployment insurance. And perhaps many of you remember Congress going through multiple battles as to whether to extend unemployment insurance for all of the people laid off during this recession. So there can be a lot of politics associated with unemployment. Additionally, with unemployment, employers who have a high number of layoffs may end up paying higher percentages of unemployment insurance. So many employers are hesitant to lay off employees so that it does not affect their unemployment, and perhaps they find other ways to have employees leave their jobs, and perhaps you have some stories about that. The other thing withheld out of the paychecks are voluntary deductions, and that can vary from employee to employee. Employees can have things such as health insurance, life insurance, contributions to 401ks, bus passes, all kinds of different deductions can be taken out of a paycheck. And the employer might match or contribute to these different deductions based on your employee agreement. So once you have filled out your W-4, we talked about that, and you're having taxes, you all are probably aware that at the end of the year you get a W-2, and in the W-2 it will tell you how much you were paid, and you will notice that your Social Security wages may be, and Medicare wages may be a different amount. You will have your wages that are subject to Social Security only to a national limit, and I will demonstrate that in a moment. But all that information that you had taken out based on your W-4 and what your employer has done, you will get a statement at the end of the year, a W-2, which you will file when you file your taxes. If you are employed for contract services only, you are not a formal employee of the business, you may be receiving a 1099 that will report any income that is paid to you. Typically, most of you may see a non-employee compensation. There are other types of incomes that can be reported on the 1099. You will also use this to file your income taxes, and if you get a 1099, you will probably be filing a Schedule C in your income taxes, and you are considered perhaps a small business. So to go on with the employer-based taxes, I want to go back here. These taxes that are withheld, the federal income tax, the state income tax, the Social Security tax, any of these taxes which are withheld from your paychecks, that is called a trust fund. And the employer is required to take that and send that into the IRS on a very frequent basis, depending on how much they are withholding. And the IRS takes these funds very seriously. If an employer is not submitting in a timely fashion those funds which have been withheld from your paycheck, this can be a very serious act to the IRS, and it is considered in many ways the same as embezzlement. You have entrusted or put into a trust fund your federal income tax, your state income tax, your Social Security and Medicare, and if that employer is running low on funds and they decide to keep your money to pay other bills and do not send it to the IRS, that is a very serious problem, and those employers may find an IRS agent knocking at their doors with guns drawn, and it is a reason that employers can have property seized, their business closed, and perhaps even go to jail. So Social Security, let's talk about that for a little bit. Social Security was put into place sometime after the Great Depression. back in the 1930s, and Social Security was set up to initially pay a one-time payment, and over time it was changed into an annuity type payment system. And it was designed at a time when people's life expectancy when they were to begin receiving Social Security and until they died was only a matter of a few years. And of course that has changed over time, and where now Social Security is available for 10, 20, or 30 years, which lends to some of the conversation as to whether or not there will be enough money to fund Social Security. But this is definitely a topic which I know many of the younger students are interested in, and one that needs further discussion at a later date. So for 2015, Social Security, I talked about ceilings. So the Social Security, both the employer and the employee pay 6.2% of their earnings. Medicare is 1.45%. But once you reach $118,500 of earnings in 2015, you no longer are required to pay the 6.2% on those earnings. That is called the ceiling for Social Security. Any money earned after that does not have any requirements of payment of the Social Security percentage. Medicare has no limits. Now, if you are hoping to collect Social Security, you do have to work a certain number of years and earn a certain number of credits, and you should look into that. I strongly encourage any of you to go to ssa.gov, the Social Security Administration.gov, and look up your Social Security account. Often that Social Security account can be a good way to find if you haven't incurred any types of identity theft, because if there are any earnings which are not on your Social Security statement that should be, or if earnings are falsely recorded on your Social Security statement, that may indicate that somebody else has used your Social Security number to falsely report or to take away income that should be included on your Social Security statement. Currently, the full retirement age for Social Security is 66 years old. That could be changing. The Social Security Administration is planning on giving a 1.7% cost of living increase. So there are a lot of very interesting facts concerning Social Security. I encourage you again to go to Social Security Administration.gov, ssa.gov, and look up your own Social Security account and see what you have in there. So once we have withheld payroll expenses from the employee's paycheck and we have made contributions ourselves, we are going to have two journal entries to look at when recording these payroll expenses. The first is called the employee's, we call this the payroll expense, and this is where we take the employee's salaries and withholdings and record it. This is the payroll expense. If you have a test question, it may ask you what is the payroll expense or what is the payroll tax expense. So the first one, the payroll expense, will record all salaries and wages earned by our employees. We're going to debit it because it is an expense. And then we're going to take that expense and break out all the individual taxes that have been withheld. We're going to break out any kind of benefits or withholdings. And we're going to record finally the payable that is owed to our employees. This is the actual salary that they are going to get on their paycheck, with all of these others held in a trust fund or in some type of fund, of which will have to be sent to the individual agencies. We would like to have a payroll have its own bank account. This is a good demonstration to the IRS that you are going to be making payments in good faith. It also serves as a lack of a temptation to use these withheld funds for other uses if your business is having some temporary financial difficulties. This is the employee's salaries and withholdings, the payroll expense. The second will be the payroll tax expense. These are the contributions that the employers add in addition to the salaries they pay their employees. And so we are going to record it as a payroll tax expense, the total amount of the matching of the Social Security, the matching of the Medicare, and also those unemployment taxes which we have to pay to support the federal and state unemployment insurance funds. So we will call that the employer payroll taxes. These are the payroll tax expense. These are paid in addition to any salaries and wages. The payroll expense, these are the wages and salaries we pay to our employees, and any additional taxes and withholdings that must be sent on to the individual agencies. In the next video, we are going to do a payroll problem and demonstrate with an individual how to allocate their wages to all of the different taxing entities and any employer taxes which must be paid in addition to the salaries and wages.